In my mind, actually, this is an incredible time to buy multifamily, and it is a bad time to buy single family, though there are lots of great pockets to buy single family in the US. So, but in general, if you were buying a million single family homes in the US, you do poorly over the next 3 years. The reason for that is the single family market has not dropped in price. It should have. The rules of money are simple. When interest rates go up, the price of real estate must drop. Multifamily, because it's run like a business, exactly has happened. Most markets have dropped 20%, some have dropped 25%. There's a couple markets that have dropped 30%. So it's been very smooth. Interest rates went up, prices went down. Now, did demand get affected? No, demand for multifamily increased. Why did the demand for multifamily increase? Well, the answer is simple. Home prices did not drop.
Welcome back to the Massive Passive Cashflow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back on the show, listening or watching if that's the case. We've got an excellent guest today, Neal Bawa, who's going to talk to you about multifamily residential investing, which is, of course, how I got started. So Neal's just taken a lot further than I have. So this is definitely one you want to listen to and take some notes. If you're driving, don't worry. They'll all be in the show notes later on. So Neal, first off, welcome aboard. I'm so glad to have you here. And I'm really excited to have you share with everybody your experience and your background too,
Well, Gary, thanks for having me on the show. I'm super excited to be here.
Excellent. So, well, let's go ahead and start at the beginning, which is always a good place to start. Tell us about your transition going from the world of technology, which is exactly where I started too, into real estate investing. I always love hearing your stories because they're all unique, but it's there's always a common thread. So we'll see.
Sure. I am a recovering technologist, so computer science degree, my data science is my major, ran a successful technology company from 1999, sold it in 2013. And when I was running it over those 14 years, each year my paychecks were getting bigger and bigger and bigger, big fat, tech salary. But because I live in California, I basically wasn't making more money when, my take home was concerned. So my take home was staying the same because my, tax tiers were just going crazy. California charges up to 13% in taxes, which I have paid. Unfortunately, the federal tax level goes up all the way to 37%. And one very painful year of my life, I paid 53.3% in taxes, including the Obamacare and Social Security overlays. And so it was getting very painful as, 2001, 2002, 2003, we're making more and more money, but my take home's not changing. And so we started to get frustrated. We had a senior partner. I was the junior partner in the business. And we started looking at real estate, and we did it in reverse, right? So most people that get into real estate, they start with a rental or a fix and flip. And I started my real estate journey in 2003 with a 30,000 square foot built from scratch corporate campus that cost $8 million, right? Because the CEO of the company said, we're not going to rent anymore. We're going to be our own landlords, and we're going to build a campus that is uniquely suited for us, and we will design every square inch of it. So we did that. Mm-hmm. We ran a business of hundreds of employees, 10 hours a day, and then in the evening we'd sit down for 3 or 4 hours every day and sort of hash out what we were doing for the construction. Didn't have any investors, didn't have any loans. It was just all cash, and we're building it, and we made horrible numbers of mistakes, and still that campus massively revitalized our business and basically put us at the very top of all of the people that were competing with us. All of a sudden we're making more money, but all of a sudden we're keeping more money because this campus's depreciation is basically knocking down our incomes. And so I was really thrilled by that. And we went on over the next 5 years to basically build or improve 4 or 5 campuses, spent millions of dollars on them, started to get debt, no investors, just, company cash. So the company's making investments, and we're getting better, and we're basically now keeping more and more money, right? And of course, I learned that popular phrase, right? It's not what you make, it's what you keep, right? So I was keeping more, and so by the time 2008 arrived, I had millions of dollars to invest that I hadn't invested. And so now I'm like, okay, now I have more money, I should be investing. And so I started going to all these real estate places, and it was the best time and the worst time because they're telling me it's the worst time. But then as a data scientist, I start mining Zillow and Trulia and the Department of Labor website, and I put it together into a statistical analysis software. I'm a data scientist. And it's telling me that this is the best time to invest in 100 years. So I'm like, is my software really messed up? Or are all these people wrong? And as it turned out, it was the best time in 100 years to invest. So over time, because I do this for a living, I started to trust the software and say, I think there's people are missing something. So I'm like, I should start talking with other people about it because I didn't want to be the only idiot that was wrong. So I said, I have this huge conference room in my campus. I have a corner office. It's 150 feet. I don't have to beat San Francisco Bay Area or Silicon Valley traffic to get to a meetup group. Why don't I start a meetup group? So in 2009, 2010, I started a meetup group. And this meetup group is about real estate analytics, the data science of making money in real estate, right? And the first time, like 4 guys show up, 1 guy's from Apple, 1 guy's from Google, 1 guy's from LinkedIn. And we have this wonderful conversation. It's too geeky though. And so we're like, we got to filter it down. We can't just have data science conversation. We got to talk real estate, right? So next time we have 10 people, and then third time we did it, there were 100 people because they were interested. What we developed was a system, a methodology, very straightforward, to rank cities for real estate. Because back then, I mean, it was open ground, right? It was like everything's cheap, right? If you truly understood the data science, you understood that everything was ridiculously cheap because properties that were built in 2007 for $250,000 were available for 90, and the cost to build them was 200,000, right? So it would cost 200 to build, 250 in 2007. Now they're $90,000, right? So when we're looking at the data science of that and comparing and going back and looking at the last 20 or 30 years, we couldn't find a year like that. I mean, our potential profit margins were absurd. They were ridiculously high, right? So we're looking at all this math and we're like, we need to share it with other people because if we're wrong, at least we have other people come beat the crap out of us and say, you're all idiots. And people would come in with this attitude of, I don't know if real estate is the right thing. And then we would spend an hour basically showing them our data science. At the end of it, they're saying, no, I've been in real estate for 20 years and I never heard anybody discuss it this way. Never heard anybody show me the delta between where we are and where the profits could be. So it was very exciting. So I'm buying like crazy. I'm buying like 1 single family, 4-bedroom, brand new from Kaufman and Broad for $90,000 every month, right? So I'm buying and buying and buying and buying. And all my friends, the Apple guys buying, the LinkedIn guys buying, the Google guys, everyone's, this is a rich group of people earning $300,000, $400,000, $500,000 salaries plus stock. And so we're all buying. And then very, very quickly, all of us end up hitting our limits of 10 homes, right? You can't buy more than 10 single family homes. Now you can because there's something called portfolio loans. Back then in 2009, nobody was willing to give us portfolio loans because it was a distressed market. And people were like, are you crazy? You want to buy more than 10 homes? You're already over leveraged, right? And I should have kept digging and digging. That's one of my regrets. I stopped at 10. Then I started buying for my family. So we ended up with dozens of them. Bottom line is I was like, what do I do now? I mean, I'm stuck. This is really great because my taxable income is reducing and every single property that I'm buying is making me money on day one because I'd buy it for 90,000 and the next morning I'm renting it for $1,000. Today my rents are $2,800, right? So it's shocking how far they've come and those properties are worth maybe 400 to 500,000 on average, right? And I'm buying them for 90 grand. But the cool thing is I was like on day one, we were making money after paying the mortgage. And so what we started doing was we started basically buying them in cash and we'd put a mortgage on them a few months later, right? So it's like buy in cash, immediately put the property, in on rents and then go back and do this. So we're doing this stuff and we're like, so what's the next step? And while we were doing it, the system that we had designed to compare cities actually became a bigger thing than the real estate. Because I started getting phone calls, Gary, from people 3,000 miles away. They're like some multifamily conference. They're like, we've heard about you. You publish this list of cities and why they're the best cities to invest in, the worst cities. And you have this very interesting phenomenon. I'm like, how do you know about me, right? Because I'm just a local meetup guy with the San Francisco Bay Area. It's like, well, somebody published your stuff on the web. I'm like, this is very interesting. So they're like calling me and I'm like, so what do you want me to do? Well, we want you to come talk about your system. I'm like, I'm not a real estate guy. I'm a technologist. I don't have any investors. I don't have a portfolio. Like you have on your website, it says this guy has a $700 million portfolio and this guy has a $2 billion portfolio. I just have 10 rentals. Why do you want me on stage? They're like, because you have nothing to pitch. You don't have a real estate business. And so I'm like, well, yeah, that makes sense. So I can just tell people about my system. And they're like, yeah, come on over. And I'm like, so do I have to pay for it? No, we'll pay for your airfare and hotel and we'll pay for your ticket. And of course, Gary, I should have been charging them money. I didn't know that. I was dumb. But I was like, sure, this is really great. I get a free conference ticket. I get airfare, and I get hotel to tell my story, which I tell in a meetup group all the time. I'm in. So I start presenting at conferences. And then the first conference is this guy, I come down from the stage, people are sort of gathering to talk with me. And this guy says, why don't you have this on the web? This is incredible stuff, right? Because this was my system. I called it Location Magic. And I'm like, what? I mean, what do you mean on the web? I have a meetup group. He says, no, I want to help you publish this on the web. So he gave me a bunch of ideas. He clearly knew a lot. I didn't know any of this stuff. And we basically created an e-learning course and stuck it on a website. And it's called, now the website is called Udemy, udemy.com. There's tens of thousands of courses on Udemy. Hundreds of millions of people are taking courses of all kinds. I mean, this course is on how to grow marijuana, all kinds of stuff. And I'm like, maybe 100 people are going to take my course. There are currently 13,500 people registered taking the course. I have thousands of 5-star reviews. That's because from the very beginning, the course has been about how to rank cities and how to do stuff yourself. None of the course has anything to do with give money to Neal Bawa or even work with Neal Bawa. It's really about, there's this really cool thing called Location Magic. It's data science, and I've simplified it for you. And I'm going to hand it to you, and good luck, right? And that's how the course has always been. So what happened there was a community of people built around me that trusted me because I was asking them for nothing, because I had nothing to offer. I'm a technology guy running a tech company. What am I going to offer them, right? Except for this course. And so years went by, I'm presenting at conferences, I'm gathering a database, and I'm just running my tech company. And that's how the evolution happened until a key event happened in 2013. So I'll stop here, but that's sort of the early part, the first decade of my story.
Okay, Neal, thank you for sharing all that. That was a great introduction. Now, I'm gathering that the model you have, because it's a model, and we're so much alike, Neal. My degree is in computer science also. Now, it may be older than yours. Mine's from 1985, and I jokingly tell people when we wrote code, we used blocks of granite and a chisel and a hammer. That's how we wrote code back when I got my degree. But here was funny. We actually had AI back then, but AI back then was nothing like it is today. It was just very rudimentary.
Not generative.
The program, everything. It really wasn't true AI. Today's AI is unbelievably brilliant. The design it can write its own code. People are afraid of it. I'm like, there's so much good's going to come out of it. Everybody just relax. There's evil people, but you watch. There's a lot of good things going to come out of this. So back to your program, though. I'm gathering based on my background that formula will literally work anywhere where you have access to the data. So mostly in the U.S. So this is good news for everybody listening because we're mostly U.S., but we do have foreign investors coming in from 30 different countries that we help invest. We represent them, and so the model does it focus more on residential, mostly on residential, single family, and then multifamily, or what are some of any other asset classes, or is it really strictly residential?
So it only works for the United States, and it only works for single family and multifamily, and works equally well for those two. It does not work for any other class, and actually people have tried to use it that way and have said that it doesn't work, which comes as no surprise to me. So people have tried to hack it for storage or senior housing, and it doesn't work well. So it works really well for single family and multifamily. Essentially, what this model is it is the opposite of a black box. A black box is you let Neal Bawa do all the work. You don't know what he's doing. Something comes out of it, and there's a list, and you say, "Oh, this city is incredible. We should go invest there." Right? It's the opposite of that. Basically, in about a 50-minute session, I simply explain 5 different parameters, where to find them on the web for any city in America. There are 323 metros in the US, so I tell you how to find it for any of them. Okay. What are the 5 metrics? What are the specific ranges in each metrics that you should have? Because too much of a good thing can be bad, especially when properties get overbuilt. We saw that in the last couple of years with multifamily. So you want to see a range, and how to apply these ranges to rank cities. And so tens of thousands of people have done this. And I'll give you the basics of it. I mean, it's really worth typing in my first and last name. I'm the only Neal Bawa on the World Wide Web. So the good news is about me. The bad news is about me. Neal Bawa space, Location Magic. So if you type that in, or just Neal Bawa space Udemy, you'll find the course. But here are the basics of the course, right? I can't give you all of it.
Okay.
I mined websites like Zillow and Trulia, and now I mine a bunch of different websites and gathered the information into a software. And I gathered hundreds of different parameters, everything from quality of schools to, crime levels and income levels, all of that sort of stuff, population growth. What I found was that you ended up with the same list. So first I had 50 parameters, and it was insanely complex. Then I had 10. Then I had 9, 8, 7, 6, 5. But the moment I went back from 5 to 4, my lists became unreliable and changed.
Okay.
So what I found was, in other words, you hear this concept of 800-pound gorilla. There are 5 800-pound gorillas, and then every other gorilla is like a 100-pound gorilla. So you end up with basically the same list of cities if you keep adding complexity. So the model became simple. So that was really awesome. It's like, yes, 5 things that matter the most. And the 5 things that matter the most are population growth, income growth, home price growth, job growth, and crime reduction, right? These 5 are gorillas. And yes, schools are not among them. And the simplest reason for that is there is a very high inverse correlation between crime and schools. So when I cover crime as a 5th factor, I'm covering schools. I'm getting the same list of cities and getting the same list of neighborhoods, right? So if I add schools in, I'll still end up with the same list of cities. So why do that job, right?
Yeah.
So these 5 parameters are important. And then what is important is the range. So a lot of people are like, okay, fine, this obviously makes common sense. It's population growth, job growth, income growth. There's nothing special here. What's special is, what is the range that is required for maximum real estate profits? Right. How much population growth does a city need for it to become, for there to be so many people coming in that all of a sudden there's just no home pricing anymore. There's just no homes available. And that is when home prices start going up at absurd numbers. Normally, home prices will go up 1% higher than inflation. So if inflation is 3%, home prices will go up 4. Inflation 6, home prices will go up 7. But when a city or a neighborhood reaches a certain percentage of population growth, job growth, income growth, that's when a switch gets flipped. And all of a sudden, there is no correlation between inflation and home prices.
Hey there, did you know you can join a free real estate mastermind session every Monday night? It's called Monday Night Live, and it kicks off at 7 p.m. Eastern. I'm Gary Wilson, and every week I host this live class, joined by investor agents from across the country and around the world. And here's the best part: no selling, no recruiting, just pure, actionable real estate education. Every Monday, we cover everything from the basics to advanced strategies. We even bring in expert guests once or twice a month. Topics like how to buy property using crypto, how AI is reshaping the real estate landscape, what the metaverse and blockchain mean for real estate deals today. Whether you're a new investor or a seasoned pro, you'll walk away with real value, and you'll have the chance to ask questions live, connect with others, and expand your network. Sound good? Then head over to realestatewithgarywilson.com. Click the Resources tab, select Monday Night Live, and you'll find recent replays plus a full schedule. You can register for any upcoming session, even weeks in advance. And if you're watching this on social media, just check the video description for the direct registration link. I'll see you Monday night. Bring your questions, your notepad, and your drive to grow. I look forward to connecting with you.
It becomes completely irrelevant. What becomes relevant is capacity, supply. And if there isn't enough supply, you see absurd numbers in real estate, right? Prices. And the same thing happens on the multifamily side, but of course that absurdity on the multifamily side is not the prices of multifamily, it's the rent growth, right?
Okay.
So there's this hockey curve that happens when certain things happen. So my course goes on to explain, and this is the one part of it where you're reliant on me. Once in a year, we recalculate the numbers, the ranges, and we publish them on our website. Most people come, they just grab them. We've never heard of them. We don't capture their information. That's not how our system's designed. It's not a lead capture mechanism. So what we want is, and you're like, why do you do this and how do you benefit? Well, I have 1,200 investors, all accredited, that have given me $325 million. It's an opt-in system. You need to want to work with us. But there's 84,000 people using our data that don't interact. They don't want to be investors. They want to invest for themselves, which is fine. Most people are like that. So it's an opt-in system where you're like, well, if you like our methodology and the way we think, maybe you want to work with us, right? Okay. Everybody else just, hey, go ahead and just use the data. And so we we show you in the 60-minute course how to find the ranges and what are the ranges. And then we give you advice that each year the ranges change. Usually the ranges don't change by much.
Okay.
But whenever a event occurs, which are now occurring with acceleration, the total amount of fluctuation in the system has increased. The total amount of, and first it was caused by COVID, then it was caused by the helicopter money after COVID, and then it was caused by interest rates increasing. So we've had 3 black swan events all tied back to one in just 4 years. And so it's extremely important for each year to come and take the new numbers, the new range from us, right? So the population growth you're looking for example, is at least 3 times that of the United States. And that range changes the most because the United States in 2011 was a country that had one of the best birth rates in the developed world. And since then, we have had a catastrophic decline in the United States birth rate. I can't say that any other country in the world is different. So the Koreans now are producing 0.6 babies, where 2.1 is the level that is needed to maintain your population. They're producing 0.6, which means that 80% of the Koreans alive today will be gone in 30 or 40 years. Their country will shrink to a third of its size. So South Korea is the worst. China is the second worst. Japan's already deadbeat economy because everybody's old. And the same is beginning to happen to the US. The good news is we're still better off than everybody else, and our catastrophic decline has only happened in the last 10 years. But because of that, you really have to find locations that have significant growth. What's good news is there are massive variations in population growth, job growth, and income growth in the same metro. I will give you an example, right? Indianapolis is not known to be a city that has great growth. Neither is Indiana as a state. But Indy right now has started to grow faster. But if you look at 85 to 90% of Indy, the growth rates are awful. Absolutely awful. And there's really not much, home price growth or really not much profit to be made. But if you look at the map of Indianapolis, if you're looking at the northeast side of Indianapolis, there's a set of cities there: Carmel, Fishers, Indiana, and Noblesville. And the growth rates there and the potential there is truly phenomenal. Absolutely. It's like, holy shit, I want to buy everything in Fishers that I can right now. Because of what is happening in Fishers. And there's obviously, this podcast is too short for me to go into it. So within Indianapolis, you have areas with extraordinarily low potential, and that's 85% of Indianapolis. Then you have 15% of Indianapolis that actually shows up at the top of our lists, right? That's the good news. And so the variation is such that even with the United States becoming a slow growth country in terms of population, there are areas of exceptional high growth. Idaho Falls, Idaho, is an exceptional high growth market. St. George, Utah, is an exceptional high growth market. Northwest Arkansas, the cities of Bentonville, Rogers, and Fayetteville are extraordinary growth markets. So there's so many of these smaller markets. Here's the problem. There are no longer any large, fast growth markets in the United States. That's the bad news. 5 years ago, that wasn't true. 10 years ago, it wasn't true. Now it's the case. You could say Miami is fast growth, but trust me, you don't want to do real estate in Miami because of its extraordinary issues with climate change and flooding. Miami gets flooded 3 times a year now, so maybe that's not the best place to go. I don't know what the people that are going to Miami are thinking, but that's their problem, not mine. So in terms of large cities, the United States is done, right? But in terms of mid-size and smaller cities, there's a lot of potential. There's still, like Provo, Utah is a brilliant place to do 10-year investing in. Right? So that's what our data is showing, that there's all these smaller places in the United States that are still growing at 2x, 3x, 4x, and 5x faster than the larger markets in the US. And that's what real estate is going to be about for the next 10 to 15 years.
Yeah. And I personally, I really do. Now I prefer the secondary and tertiary markets because, like in Indiana, for example, by the way, I've taught a class in Carmel about 10 years ago on real estate. I taught real estate agents.
Hasn't it changed dramatically? I mean, Carmel has just changed incredibly, right? You go through it and you're like, wow, this is bougie.
It's nice, but you've also got like Lafayette, Indiana. It's a small college town. Right. It's a great place to invest. Same thing with Fort Wayne, Indiana. So
Fort
For
Wayne
everybody
in
listening,
particular is one that I love to talk about. I tell
oh,
people,
awesome.
sometimes people tell me Indianapolis doesn't work for us. And it's like, well, just drive out to Fort Wayne.
Yeah,
You're not just driving out from Indianapolis, you're getting closer to a bunch of other metros that Fort Wayne's closer to on the other side. So I think
yeah,
Fort Wayne is a remarkable market. It's not good enough for us to build yet. So my construction business, I have two businesses, one that buys, one that builds, doesn't
yeah,
work in Fort Wayne at all. It does work in Fishers, Indiana, because the prices that rents are higher. But in terms of buying, yeah, Fort Wayne works all day long.
yeah. Well, I love the model. You talked about the range, and I can see where that's so vitally important for a couple of reasons. Number one is, you have like Dayton, Ohio, not too far from Fort Wayne, Indiana, actually. That in the Great Recession or coming out of it, their average home price was like under 70,000. But now look at them. I mean, it's near one of the largest, Great Patterson Air Force Base, so it's got more stable economy. But I like their ranges for that reason, but also because economically each market is different. I mean, San Francisco is completely different from Indianapolis, and that's different from Chicago, different from New York City and Atlanta. So that philosophy has applicability not just because of the size of the market. In other words, home prices in Macon, Georgia are much lower than San Jose, California, but also because in each market you do have that variability at the micro market level. So that's just brilliant. And one thing I want to, if we could, I know we're going to run out of time quickly here, but I'm glad that everybody can use this. So even if you're in Israel and you're investing here in the States, I suggest you look up Neal. Go to the website, go to Multifamily University, by the way, and start learning. We always start with education. So Neal, our philosophy on our real estate production team is right education plus right information plus right action equals right results. So you have applicability there. But what I want to ask is, we just had a major election. We've got the turnover administration is about to happen, and there's all these factors. A couple of I would consider major conflicts in the Middle East and also in Ukraine, and other factors going on in the world. But I know, and everybody's probably asking you this, Neal, but there's no test. We're not going to grade you on this. But I'm curious too. I mean, what does your data look like going forward? What are you seeing, or what do you think we should be on the lookout for, just on an opinion basis?
In my mind, actually, this is an incredible time to buy multifamily, and it is a bad time to buy single family, though there are lots of great pockets to buy single family in the US. So, but in general, if you were buying 1 million single family homes in the US, you do poorly over the next 3 years. The reason for that is the single family market has not dropped in price. It should have. The rules of money are simple. When interest rates go up, the price of real estate must drop. Multifamily, because it's run like a business, exactly has happened. Most markets have dropped 20%, some have dropped 25%. There's a couple markets that have dropped 30%. So it's been very smooth. Interest rates went up, prices went down. Now, did demand get affected? No, demand for multifamily increased. Why did the demand for multifamily increase? Well, the answer is simple. Home prices did not drop. So they're supposed to hit their peak in March 2022 because that's when interest rates were low, and then after that, of course, the Fed started raising rates. So prices should have gone down. Well, they didn't. They first flattened out and then actually went up slightly. So if you look at prices today compared to what should have been the peak, March 2022, when rates were low, home prices are higher in the United States, higher in almost every market in the United States. So when you look at that, single family this time in this cycle did not obey the rules of money. It did not obey the rules of interest rates. And the reason for that is two big reasons. One is tens of millions of people like me are locked in at interest rates. My home's at 1.75%, so I can't move. I'm locked in, right? So the lock-in effect means people are not moving. And the other thing is that people at this point of time are considering their home, because it's going up, a value, and so they're not selling enough of them. So there's not enough inventory. At some point, I don't know when, that problem will be solved, and home prices will have to either come down or plateau. I don't think they'll come down, but I think that they'll plateau. The reason for that is I'm a believer that we've moved into a world of 3% inflation from the world of 2% inflation. In a world of 3% inflation, it's actually hard for home prices to come down, but they can plateau. So my data shows that we might hit a plateau for home prices unless we have very high inflation for the next 3 or 4 years. Whereas with multifamily, we should show an upward trend for 3 big reasons. Number one, the prices are cheaper, right? They're 20, 25, 30% lower than they were. Number two, in the last 2 years, multifamily rents in the United States did not increase at all. So, well, I should say maybe minor increases. Some markets a little down, some markets a little up. But overall in the US, they were flat for 2 years. Why? Because we had the largest amount of supply, 2-year supply in US history that slammed into the multifamily market in 2023 and 2024. So when you have a lot of supply coming in, it's hard to raise the rents because there's a bunch of other options. Well, that supply in many markets has ended now. In some markets, it ends in the middle of 2025. And in all markets, it ends at the end of 2025. So pricing power returns to the multifamily industry. And when pricing power returns, that's when the value of properties goes up, because the value of multifamilies is tied to our rents. If rents go up, our income goes up. If our income goes up, our prices go up, even if cap rates are not changing. I don't expect them to change this year. I think we're going to have basically interest rates where they are pretty much the whole year. So I don't. They might go down a little bit, but I don't think so. They might be slightly lower at the end of this year, but I don't think that's going to change the cap rates much. So if cap rates are constant, the only thing that changes value of multifamily is income. Well, that's where we are going to be very strong. The entire industry is going to be very strong, except it's going to vary by regions. The Northeast and the Midwest will outperform. So we're going to see very strong rent growth there, maybe 4+%. Whereas the Southeast, where 90% of the new construction was, is going to underperform with rents being 2.5% up, which is not terrible. But for the Southeast, it's terrible. Because the Southeast has been, the booming part of the U.S. with all of the boom towns. And so it's actually pretty terrible. Where for the Midwest, 4% is is an incredible growth number. Remember, if you get 15, 20% rent growth, you're doubling investor money because you're using leverage, right, on top of that. So if you get a 4% year for the Midwest, you're feeling really, really awesome. And I'm not much of a Midwest guy. I'm more of a Southeast guy myself. But that's what the numbers are showing, that the Midwest is going to do really well. So that's my feeling. Single family flat, not just for this year, but for several coming years. Multifamily should go up simply because we've come out of a 2-year really bad time frame of no rent growth and a decline in prices, to where we should see an increase in prices and an increase in rent growth just because of trends. It's just part of the cycle.
Gotcha. Okay. Well, I appreciate that. I mean, I agree with you. From what we've seen, I've always been a multifamily guy. In fact, I didn't even buy any single families for about 5 years when I started investing. And it was just, one of those opportunity times I decided to do it, and I would buy them in bulk. And I kept a lot of them, actually. So now, how everybody listening here is starting to wonder, I'm sure, like me, how can people work with you, engage with you? I did mention Multifamily University is a good place to start. Is any other information you can provide people for his contact or offer? Yeah.
If you're listening, you should know that I run 2 companies, and again, I'm very easy to find by just typing my first name, last name in, and then clicking on my company names. So I run one company, GroCapitus. We have about a portfolio that has varied in size over time. 1,000 plus investors, 660 million, I think, is our current number, and you can invest through us. My second company, which is my true passion in life, is Mission 10K. It is our mission to build 10,000 rental townhomes for the middle market, for the mid market, by the last month of 2030. So we are on our mission. We've already built a bunch, and we're making great progress towards building 10,000 rental townhomes, because Mission 10K is a replacement for the American dream. 18 million American families will never own a single family home because their income is so far from the income needed to qualify that they will never catch up. Right? They're $40,000 away, which is too big a gap. Those 18 million Americans don't want to live in my apartments. What they want to live in is something as close to a home, and that's a rental townhome with a garage, with a backyard, nobody living above and below you. So my mission and my team's mission, something that gives me great passion every day, is Mission 10K. And you can check that out at mission10k.com, mission10k.com.
Well, I love it. So I've got the GroCapitus, GroCapitus, everybody listening. GroCapitus, if you'd like to participate in investing. Mission 10K is building 10,000 townhomes for rentals. That's awesome. And then Multifamily University.
Yeah.
And guys, obviously, just Google Neal Bawa, Neal, and Bawa, Bawa, and you'll get the true, authentic Neal. So Neal, I really appreciate you doing this. I know you just gave a ton of information and golden nuggets, and that's what makes the podcast world go around. Everybody listening, I hope you please leave a review for this one. This has been one of the best ones, and you got a lot of golden nuggets, lots of opportunity there for you to participate. So Neal, thank you again. Thank you, listeners, and those of you watching. We will see you on the next Massive Passive Cashflow Podcast. In the meantime, God bless you and all of your loved ones.
Thanks for listening to this episode of Massive Passive Cashflow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.